Hi, so what are the most common pitfalls for algorithmic trading strategies? So people might answer stuff like, oh, the live execution, slippage, it eats all the returns. Or maybe the trading strategy idea wasn't that great that you tried. Well, those could be the cause, but a lot of times it's overfitting. So stay tuned to learn how to reduce the impact of overfitting, reduce overfitting, and mitigate overfitting. But you might ask, what even is overfitting? So, overfitting basically means that you have historical data and you fit, so basically adjust the parameters of your trading strategy or model too much to that data, and such that it only works on that exact data that you trained on the strategy. If you present any other data, be it historical test data or live data, to that strategy, it will fail. And what you can imagine this as is basically that, for example, if you have this kind of a function and you sample data from it with some noise, then there might be like a lot of data points, and the best function through it is of course something like this. But if you overfit, it would be something along those lines, where basically it exactly mirrors the data, the model, but only the data you train it on. So what are some common causes of overfitting? So there could, for example, be, especially with machine learning models, too many parameters. Because if you have too many parameters, what basically happens is that you tune them all to this very limited data set, limited in terms of size and data points, and then it doesn't generalize because these parameters are can capture so much information, but there's limited information in the data, and that just means that it basically has to be completely only optimized and trained on that data if you have too many parameters. Another common pitfall is look ahead bias, which is basically when one way or the other, maybe because your code wasn't programmed correctly, because of some issues with the data, the strategy or the model can look into the future. So that's basically what look ahead bias means. And of course, if you can see into the future, it's much easier to, produce a great return with historical data. But then if you try it in live trading, the strategy is not able to look into the future. So then, of course, it will lead to losses. And the last one is called survivorship bias. And that basically means that your data is too clean. So, of course, you want clean data, but you don't want data that, for example, does not include any companies that might have gone bankrupt. You want that data. You want the data also from companies, so from stocks basically, where the company has gone bankrupt, because you want your strategy or model to avoid those companies. Okay, and here are some very good mitigation techniques. So the first one is walk forward analysis. So what is that? Basically, instead of having one gigantic training optimization data set and then a small test set, or you only have training data and then you test it live with paper trading, what you do is you basically take a defined period of time, let's say 3 months, 6 months, or a year, for example, and let's say your data goes back to 2010, then 2010 you take as the first training data set and 2011 as the first test data set, and then you evaluate. And then you take the whole of 2011, okay, and you train on that and evaluate on 2012. And that just gives you much more testing, much more insight basically into how your strategy works for out of sample data, or your model works for out of sample data. And that is the crucial part here, because all live trading is with out of sample data, with data your strategy or model has not seen yet. So this walk forward analysis basically makes it much more robust. So basically the takeaway here is, in general, you want out of sample testing, because you don't want to train and then test on the same data, because that's basically like looking at the answers to an exam and then testing yourself on the exam. That doesn't work like that. So what you always want is out of sample testing, and for example that's very good with walk forward analysis. And otherwise, what also makes a lot of sense is regularization and normalization. So I'm not going to go into those topics right now. That's like those are too deep of topics. So just look them up and see basically what you need to do for your specific use case, whether you're doing machine learning models or just plain old statistical trading strategies. And this one is very relevant if you're doing machine learning models, because it has been found out that if you keep on training on the same data, even if the loss function is at an absolute minimum, it basically doesn't get any lower and you continue training for a lot of epochs, a lot of iterations, then at some point, all of a sudden, the performance on the validation / test set, data set, will skyrocket. And this is called grokking, Grokking, same name as the chatbot from XAI. And it's not completely clear why this happens. The science isn't completely agreed on why this happens, but it is a phenomenon. So if you're doing machine learning models, this is something you should look into. And basically the takeaway is that even if your model has already a loss curve like this, keep on training and see what happens, especially with the validation test set. So one of the takeaways is basically to keep it simple. And this applies both to machine learning models as well as to statistical trading strategies, because the simpler, the more robust. Okay, the more complex, the more brittle, basically. That's the takeaway. And especially if you're talking about statistical trading strategies, you should be able to explain your trading strategy to a 12-year-old. Because, with machine learning, okay, these are black box models, basically. So you don't know exactly what's going on there either, because you didn't basically form and produce and build it yourself. But with statistical trading strategies, you need to keep it simple, not 20 indicators, probably more like 1, 2, 3, 4, and thus be able to explain it to a 12-year-old. And another really good thing is to basically regularly retrain and re-optimize your strategy / model. And regular does not necessarily mean very often. I would stick to a regular schedule. You could do once a month, for example, but don't do it too often. And another very, very nice thing, especially coming from machine learning and AI, is ensemble techniques. So what you could do is, for example, you can imagine it basically like a group of experts, and they have a council and they vote, which way should we go now. And this is especially useful for machine learning, where you then have a couple of different actions it can suggest, or each submodel, basically you can imagine it, from the ensemble can suggest, and then they together agree on the action to take, basically. And you can even weight them differently. For example, model A can have a higher weight than model B, and model C has the lowest weight. You can also do it like that, for example. And then they need to, so to speak, vote on the action. So that could be, for example, buying, holding, things like that. And that just makes it also way more robust, because it's unlikely that one model can capture and be great at like all market regimes, all market conditions. But a lot of different models together are most of the time more intelligent. All right, and the next point is especially for machine learning models, because feature selection and feature engineering is very important, because some features are very good, okay, but others are basically just noise. And if you add them to your model, you train your model on noise, it will perform worse, of course. And another approach that's basically the opposite to grokking, which is especially useful if you don't have that much computational power, or you're, for example, renting GPUs by the hour for machine learning especially, is early stopping. So that basically means stopping as soon as you say, okay, the loss right now, the loss function has a value that is acceptable to me. As soon as that happens, you can do, for example, early stopping. And what's also very useful, for example, for a parameter optimization, and this is a separate point, is to stop early in terms of, for example, if the profit and loss is very bad after, during a trial, after, for example, a few days, or no trading has happened at all. Okay, and then some real world tips. So always start with paper trading. Don't just go from backtesting to live trading. That makes no sense, because the real test is paper trading, and then the real test is live trading, but that comes only after paper trading, because you can't simulate, all the peculiarities with, live execution as you can with paper trading. So you don't have that in backtesting, so always do paper trading. And then really important to always look at the specific performance metrics, like for example, the Sortino ratio, the Kalmar ratio, max drawdown, return. If you want, also the Sharpe ratio, although I'm not the biggest fan because it also penalizes, so basically punishes volatility in the upside, which doesn't really make sense. But you can also, for example, look at the Sharpe ratio. So paper trading, look at performance metrics, and then have a kill switch. So if something goes wrong, or if you just think that something is up, basically you want to stop your strategy, you should be able to do this and implement this and define this and test this before you ever deploy any capital. Okay, and then the very two last points. So don't ignore that transaction costs are going to eat into your profits, and there's going to be a certain commission, fee, slippage, latency every single trade, and that eats into your profits, and that can turn a 25% return into 15%, for example, or it can turn a profitable trading strategy into an unprofitable one, depending on how often you trade. So, and the risk reward ratio per trade. So you need to model this very, very accurately for your backtests, and only then can you optimize the parameters, optimize the model, because then you go off of the actual real, the proper assumptions, basically. And don't assume that markets are stationary. Assume that markets change, okay? So the model that worked perfectly yesterday might not work tomorrow, and just continually monitor this, but also don't get into this optimization addiction. It's good to optimize, like to re-optimize, retrain your strategy or model every now and then, but maybe not every week, maybe not every day, okay? But definitely keep in mind that markets do change. Okay, and that was it for this one. So remember that this is not about building the perfect backtest, because perfect backtests lead to disastrous live trading. This is about making your strategy and your model robust, okay? Robust for live trading. That's what you care about. That's the only thing you should care about, because the best, backtest, you can't buy anything with that. The goal should be about live trading and preventing or minimizing or mitigating overfitting is the best way to lead to higher profits in live trading. So yeah, I hope you got some value out of this. Otherwise, drop your criticism in the comments. Also, drop down below what other tips you might have, and smash the subscribe button and the bell, and hit the like button. And thank you so much for watching.